Welcome to The Explainer. Today we are unpacking a really profound divergence, one that's probably been driving you a little crazy. We're talking about the soaring stock market completely clashing with our very fragile macroeconomic reality. If you've been glancing at your portfolio hitting record highs and then immediately reading these incredibly sobering news headlines, wondering how on earth both things can be true at the same time, well, you are in the exact right place. Let's dive right in and break down the May 2026 market paradox.
Here is our roadmap for today. We're going to start with the 2026 market paradox, map out the macro chain reaction, unmask some major illusions happening in corporate reporting, and finish up with a low volatility imperative.
Section 1. The 2026 market paradox. It's Wall Street versus Main Street. There is an absolutely stark contrast playing out right now. On one hand, we've got this incredible Wall Street momentum. The S&P 500 has been up for 8 consecutive weeks, and tech giants are just surging to multi-decade highs. But at the exact same time, Main Street is suffering an unprecedented drop in consumer confidence. U.S. consumer sentiment just hit an all-time low of 44.8, and the labor market is flashing some serious warning signs too, with summer teen hiring hitting its lowest point since 1948. The big takeaway here is that the wealthiest tier of Americans, combined with this massive wave of AI-driven corporate spending, are currently insulating the broader market. And that insulation is completely masking the massive underlying depression in everyday consumer confidence.
So, what does this actually mean for your money? Well, we are witnessing the vanishing equity risk premium. Now, that's just a fancy way of describing the extra return you'd normally expect to get for taking on the risk of buying stocks. Right now, the expected return of equities has completely converged with ultra-safe 10-year Treasury bonds, right at 4.49%. Think about that for a second. This historically significant convergence means that buying stocks today is mathematically as unattractive as it was immediately following the burst of the dot-com bubble. Why is this happening? Because relentless inflation fears have powered a global bond rout, relentlessly pushing Treasury yields higher and higher.
Section 2. The macro chain reaction. Moving from global geopolitics straight down to domestic credit. This step-by-step sequence is absolutely crucial because it connects the dots. It proves exactly how events across the globe dictate your very own domestic financial pressure. It's like a giant domino effect. It starts at step 1 with geopolitics, specifically the US-Iran conflict escalation and massive shipping disruptions. That instantly triggers step 2, energy, keeping crude oil at really elevated prices. Naturally, that expensive energy feeds right into step 3, inflation, projecting the core PCE, which is the Federal Reserve's favorite inflation gauge, to hit its fastest rise since 2023, which, of course, forces the Fed's hand in step 4, monetary policy, keeping rate hikes firmly on the table. And finally, that all lands heavily on step 5, credit. This exact chain reaction is what directly forces your 30-year mortgage rate to spike all the way up to 6.51%. It's wild because we are watching global extremes completely collide. Over in the Middle East, the Strait of Hormuz bottleneck carries 20% of the entire world's oil traffic. That threatens massive upward pressure on oil prices, especially since China's undocumented strategic reserve drawdown is kind of hiding the true global supply deficit. And then that global energy bottleneck washes up on our shores and literally freezes the U.S. housing market. Homeowners are completely trapped in their ultra-cheap pre-pandemic mortgages. When they see current rates spiking back to 6.5%, absolutely nobody wants to sell. That locks up the housing supply and pushes the timeline for a sub-6% rate thaw all the way out to late 2027.
Section 3. Unmasking the illusions. Let's dig into corporate reality.
Okay, let's talk about where the smart money is actually going, because institutional capital is entirely shifting its priorities. Capital is completely fleeing high-end EVs like the Ferrari loose and general corporate bonds. Investors are just dealing with intense market fatigue and duration risk, which is the danger of holding bonds as interest rates bounce around. So instead, all that capital is surging aggressively toward AI hyperscaler infrastructure. We're seeing massive rallies for companies like SoftBank, heavily driven by their OpenAI holdings, and super successful IPOs for companies like Fervo Geothermal. And that's simply because there is an insatiable demand for always available baseload power to feed these massive, power-hungry AI data centers. Now, speaking of AI, it's honestly fascinating how the leading chipmaker, Nvidia, has cleverly re-architected its revenue reporting to entirely control the market narrative. Under the so-called New Huang strategy, they are deliberately, and very loudly, highlighting this massive 115% hyperscaler growth. But beneath the surface, it's a really clever masking effect. They took their sluggish 8% gaming segment and strategically lumped it in with highly speculative R&D, like autos and robots. They are essentially hiding their consumer slowdown to completely protect the AI momentum narrative from any kind of Wall Street panic. It's a brilliant narrative game changer.
But hey, beneath all that shiny AI hype, America has a pretty terrifying physical vulnerability that we really need to talk about. A massive $750 billion slice of America's manufacturing imports is highly vulnerable to a single point failure. We are talking about absolutely critical dependencies here: advanced chips, high capacity batteries, and pharma APIs, literally the active ingredients in our medications. According to McKinsey, fixing this giant Achilles heel requires a staggering $2 trillion capital injection just to rebuild the industrial base. And keep in mind, that money is completely separate from the current AI infrastructure spending spree.
And you know, AI isn't just about the hardware and the data centers, it's fundamentally shifting the labor market in real time. As the very first natively AI-fluent graduates hit the workforce, they are bypassing traditional, repetitive grunt work in favor of high-leverage AI augmentation. Because of this, JP Morgan theorizes something incredibly fascinating. They suggest that the rising fears of AI job disruption will naturally limit employee wage bargaining power. So, unlike the nasty stagflation of the 1970s, this AI dynamic actually artificially caps the wage price spiral we might otherwise expect in today's high inflation environment.
Section 4. The Low Volatility Imperative. It's time to build a defensive posture.
So, taking all this in, JP Morgan's data reveals a really distinct mathematical asymmetry that every investor absolutely needs to wrap their head around right now. Check this out. In scenario A, if yields spike to 5%, the overall broad market struggles, right? But a low volatility posture defensively outperforms because there's a severe rotation into capital preservation. Conversely, in scenario B, if yields drop and normalize, those same low volatility stocks still successfully catch the upside right alongside a rallying broad market. This setup is a win-win. It's mathematically defensive regardless of what the Fed decides to do next.
So, how do we actually build this defensive posture? Well, it means allocating heavily into heavily insulated sectors like utilities, financials, consumer staples, and healthcare. Why these exact sectors? Because they all pass some very strict selection criteria: low historical price volatility, low earnings volatility, high net income margins, and quality dividend correlation. But most importantly, they guarantee a mandatory yield above 1%. That is exactly how you build a fortress portfolio to weather 2026.
Believe it or not, all of this hyper-modern financial data actually loops right back to a foundational, centuries-old truth. Way back in 1667, the mathematician Abraham de Moivre proved this. He wrote, "The risk of losing any sum is the reverse of expectation, and the true measure of it is the product of the sum being adventured multiplied by the probability of the loss." Let me translate that for today. When the sum you are adventuring is multiplied by the high probability of loss in today's incredibly fragile macro environment, the math firmly, absolutely demands capital preservation right now.
Which brings us to the ultimate question, a real fork in the road. With the equity risk premium completely vanished and massive geopolitical bottlenecks severely underpriced across the globe, will you prioritize market participation or capital preservation? I'm going to leave you to ponder that stark choice as you navigate this unprecedented economic paradox in your own portfolios. Thank you so much for joining me for this explainer, and keep learning.